Welcome to TheoTrade. This is Don Kaufman. It is February 3rd, 2018. All right, where to start? Some volatility hits the market this week, but let's just put this, kind of in perspective right now. First and foremost, when you're looking at the idea of volatility, you have to recognize, so the VIX took off to the upside, right? The VIX is trading, the 16, the 17 handle. Everybody starts to get kind of excited over there. But you have to realize, as I said, kind of in the larger perspective, all right, listen, the VIX is just catching its stride. And you have to recognize that this marketplace is really moving from a period of incredible and sustained efficiency to relative inefficiency. And that's something we're going to show in just a few minutes here as we kind of continue this video, and we'll take a look at a few of the charts. Now, again, VIX hasn't even really caught its stride. Sure, it shot up over there, okay? However, at the same exact time I say that, we have an expected move from last week. Now, the expected move last week was kind of in the mid-30s, meaning that the S&P, specifically the SPX, was supposed to move right around $36. How far did it move? About 110. So you're looking at beyond a 3 standard deviation move, which is, well, the first time in a very long time we've seen this. However, as I mentioned a moment ago, we're moving from this period of efficiency to inefficiency. And if you look back at the last couple of weeks, we've been breaking through the expected move time and again. Again, I'll show that here in a few moments as we get to the charts. The next thing we have to look at is really what's causing this. Now, I know everybody's got their head caught up in the tech clouds, as I call it, which is the monsters of tech, right? It's your Googles, it's your Apples, it's your Facebooks over here, and everybody, of course, is looking at the earnings announcements. Meanwhile, they're missing the big picture. And that big picture is nothing more than, it's the bond market. Now, obviously, everybody's looking at the bond market, and the bond market's selling off over here, and, the interest rates are exploding to the upside. What is the broader impact? Well, to be really specific, what you should be looking at isn't necessarily just the bonds. And yes, the bonds are selling off, but the impact will be the financials. And the financials really breaking down, it's kind of what I call the financial snapping, is really what caused the heavy sell side activity that ultimately we saw on Friday. It's all about the financials. So the next time you're looking at your Apple and your Google and your Microsoft, oh my, it's Amazon, you're missing the bigger picture, okay? Look at the financials because they're really leading the pack year to date. Okay? And that's what could ultimately snap the back of the entire S&P 500. Now, to lastly kind of quantify, a little bit of volatility, one of the things I think we need to recognize and expect this next week is you very well may see wild rallies to the upside. Now, of course, people are going to be like, it's a dip buyer, it's a dip buyer. Nevertheless, what you had a lot this past week is some shorting activity. So, how ultimately do shorts cover? They buy it in. And you have to be extraordinarily careful. Again, in a period of volatility, some of the most significant, some of the most wild moves have been to the upside. All right, knowing that, the next thing you got to think about is there really going to be any more sell-side activity? Because quite frankly, when you start to look at the markets, which again, we'll do here in just a moment on the charts, you have to recognize, again, bigger perspective. Traders haven't even felt the fear yet. Right? If you don't know what that means, you haven't traded long enough. And when you stare down the face of the marketplace and you're looking at it and it's down what? Come on, we were down just over 2% on the S&Ps. We're scratching the surface, possibly of something much larger over here. Let's get right to it now. Thanks everybody for joining us here at TheoTrade. Now we're going to go to the charts. All right, here we are looking at the charts. Let's pick up where we left off, talking about the VIX. So as I said, the VIX for the most part is just kind of stretching its legs, catching its stride, if you will, coming in late in the trading day on Friday to the 16 and even the 17 handle. However, if you zoom out, again, we're just looking at a 9-month chart here, but if I zoom out a little bit in time, we'll open up like a 3-year daily, you'll be able to gather a little bit more perspective, again, on what the VIX is capable of doing. Now, you can see that the VIX starts to get a little bit more interesting above the 20 level. It hasn't spent much time in the last 3 years above the 20 level, other than, again, a couple of announcements, the Brexit, but right in this neighborhood here. This was early 2016. The marketplace did sustain a rather severe sell-off all the way, and specifically the S&Ps, all the way down back to 1800. As I said, when the VIX is kind of catching its stride, come on, we're at 17 during that last major sell-off, and that's all we have to compare it to. We're back up at 30. Now, a lot of people are going to point out a million different things in the VIX. I'm going to remind you of something with the VIX. The VIX is a calculation. Okay? It's a calculation to volatility of the SPX. And that calculation's actually been changed a number of times. In fact, the most recent change to the VIX calculation was in October of 2014. So I know many of you, of course, I'm gonna look back 20 years on a weekly. Yeah, well, the reality is, though, they changed the calculation here in 2014. And what did they change? Well, ultimately, weeklies really came into, fashion, and they really have been traded heavily. So they included weeklies in the calculation for the VIX. Now, my belief is that probably suppressed a bit the VIX reading. So you're getting much lower readings often in the VIX, not to mention, of course, the Fed throwing money into the marketplace. That's a completely different story. Nevertheless, the VIX at 17 really just catching its stride, and I don't want anybody to start to panic out there. And if we have a VIX trade on, it's all right. Let the trade ultimately come to you. What's the worst that's going to happen? The VIX can revert back down for a few days? Well, that should be expected. Okay, onward and upward. The next thing we want to talk about is what I term the efficiency trade. So what the efficiency trade has everything to do with is what we term expected move. For those of you that are a little bit newer to this, we look at expected move on this weekend video. Literally every single weekend video will do the expected move. And what the expected move is based on, it takes the implied volatilities. For the most part, it takes the options themselves in the SPX. It averages the implied volatilities. It pretty much averages the option prices and derives what the market is anticipating movement to be for any given period of time. And if that's all confusing, here, right? This is February 9th. February 9th happens to be this coming Friday. Remember, with expected move, it's really forward-looking. You're like, oh yeah, so is a Fibonacci. No, Fibonacci is actually forward-looking based on what? Past data. What you have here in the SPX is a definitive marketplace. When I say a definitive marketplace, people, these are bids and offers. Okay, there are billions of dollars at risk in this marketplace. Now, the reason I like the expected move so much is if you look at the expected move for this next Friday, it's just shy of about $60, which, if you know anything about expected move, the last couple of weeks, even last week, we saw like a $36 expected move. The week before that, was also, $34, $35. But we've had a ton of weeks where the expected move was $22. To see almost a $60 expected move, yeah, that means put on your big boy pants. We're going in. There's going to be a lot of movement this next week. But with the expected move, I talk about, again, these periods of efficiency and inefficiency, and I want to, again, kind of quantify that just a little bit. For that, I'll go to the chart. So I've been tracking expected moves for years, and I track the weekly expected move. Ultimately, I look at the expected move on a Friday or a Saturday for the following Friday. What that gives me is it gives me a feel of, like, again, what is the marketplace itself saying about risk this next week? It says the risk is going to be fairly heavy. The volatility is up to 19%. I mean, the 19% is like a VIX for the next 6 or 7 days. And again, a $60 expected move. But I say the efficiency and inefficiency. What that deals with is, if I kind of zoom in over here, these little lines are the expected moves drawn each week. Like, right, this is where the week would start, okay? Here is the upper band of expected move, the lower band. Like, this is like any other week. This is probably plus 22 or minus 22. What that means is the market's capable of moving up $22 or down $22. And guess what? It stayed inside of it by the end of the week. And the week before it stayed inside of it. And the week before it stayed inside of it. And the week after it stayed inside of it. And the week after that. The week after that, ooh, look, there's a breach. But in a period of a efficient marketplace, okay, and that's a marketplace that's typically not very volatile. In a period of efficiency, you're getting a marketplace that's just adhering week in and week out, even during this wild rally to the upside. almost every single week we're inside what's expected. Couple of breaches. For the most part, over the last 3 years, we've been inside the expected move, okay, just shy of 85% of the time, which is pretty shocking because you're only supposed to be inside the expected move about 68% of the time. Well, lo and behold, let's look at a few of the most recent trading weeks. And I'm just going to highlight these for a second. So here's 1, 2, 3, 4, and now 5. That's 5 of the most recent trading weeks. Do you realize only one of those weeks did not breach the expected move? Okay, we haven't seen anything like that recently. And then what I've talked about for the last few weeks, go check out some of the weekend updates, is how the market was basically getting inefficient, which means that it's starting to crack through the expected moves. The options market is all over the place. They're not doing a good job of pricing risk. And guess what? Now we have this breach. Again, last week, we're looking for an expected move, in the mid-30s. We had a 110-point drop in the SPX inside of the week. Again, signs of inefficiency everywhere. Now, what this is going to do, though, it's actually going to create a lot of opportunity. A few weeks of some volatility, and then what's going to occur is that the volatility won't contract for a fairly substantial period of time. It's going to allow us to sell premium again. And that's something I'm going to be talking about throughout the course of this week here at TheoTrade. Okay, switching gears a little bit. So we talked about the VIX. We talked a little bit about the SPX. Okay, one other thing I want to throw to you is we're going to bring up the S&P futures. I'll zoom in for just a moment. So it's starting to stand out, obviously, a fairly precipitous drop, if you will, in the markets. What I want you to think about coming into Monday, Tuesday, Wednesday, listen, could we continue to drop more? Of course we can. Does anybody have any idea where we're going to go? No. Listen, newsflash, that's what volatility is about. But I want you to recognize that in periods of volatility, and I don't want you to get this confused, in periods of volatility, okay, you could see absolutely wild rallies back to the upside. Because what occurs, these are the S&P futures, what occurs is that big trading firms have to short, okay, dynamically into the market. That is, they're actually selling S&P futures as the market's going down to help mitigate their risk. Well, you sell S&P futures into an oblivion, and all of a sudden somebody steps in and covers, and it sparks these violent upside moves. And I want you to think about that. Now, the violent upside moves, the thing with that is you're not going to know if it's just short covering or if it's, is this a buy the dip? All I can tell you is right now, I'm not going to be out there trying to buy any dip. All right. In fact, when we see these wicked bounces, and you will see wicked bounces, initially, I'm going to be selling into them, meaning that it's a good time to actually re-up and possibly short. For instance, if we popped right back into the 2,800 handle, could be a good time to come in and sell them again. And I believe the psychology of this is going to torment retail traders. You have been conditioned at this point, and again, I don't want to sound too defeating here. You've been conditioned at this point in time to be the Pavlov's dog of the marketplace, right? Every time we sell off, it rings the dinner bell for you to come in here and buy the dip. And that is going to be an extraordinarily dangerous place to be right now, because you're not going to know if they're buying a dip, okay, or if they're just, covering, buying to cover, and then re-upping to hit them again. And that's what you really have to be concerned with. Now, again, when the futures reopen, like on Sunday night, this marketplace could be Mr. Toad's wild ride. Again, that's what volatility is about. Don't forget it. The other aspect is we saw a little sell side activity. But again, you have to constantly stop, put perspective on things. And here's a perspective for you. So the markets were up almost 7%. Now they're only up 2%. Okay, so we gave back a couple of percentage points. But even to get back, let's zoom out for a second here and drop to a 1-year chart. Even to get back to where we were this past summer, right? And I'll snap it off the percentage charts. But to get back where we were this summer, you realize we were below 2,500. we haven't scraped the surface. Yes, we saw some sell side activity, but we really haven't scraped the larger surface. And by that, I mean, you'll know when there's real selling out there. Okay. A 2% move. All right. It gets interesting. All right. But you still got Amazon up $40 in a day and people are still focused on tech stocks. You have to understand that you have to look at underlyings like Facebook. You have to look at underlyings like Apple. By the way, Apple, speaking of Apple, is now officially in corrective territory. It's dropped what? Over 10%. Okay? But you got to look at these underlyings and you got to say like, "Oh, I don't want to touch them for anything." You have to do what I call feel the fear. And again, if you don't know what that means, you haven't traded long enough. You just simply haven't traded long enough, or it's been so long, okay, that you've actually seen a sell-off. You got to see people getting almost sick to their stomach in there. Now, again, everybody's focus happens to be specifically on technology. Right now, it's all about this. It's all about the XLF, okay? It's about the financials. Because quite frankly, again, if you zoom in on a year-to-date percentage, the financials were up just about 8.5%. They dropped. But the first sign of drop was on Friday. And I said time and again on videos all throughout the course of last week, even last weekend, it's the financials that are going to snap the back, specifically of the S&Ps. Okay, arguably the largest sector. I know everybody, tech sector, but the financials, okay, really have so much order flow that they control, even outside of the banks over there. And as the bonds continue to sell off, okay, and yes, the story is initially bonds, but now it's about financials. In fact, this next week, it wouldn't surprise me to see bonds have some wild rallies even throughout the course of the week. Because at some point, if there is continued selling in the S&Ps, people may start to sell the market, turn around and be like, that's it, now I got to buy bonds again. So the bonds might not be this continual slide to the downside. Again, there's a tremendous amount to think about. This is going to be a week like, members of TheoTrade, tune in to the chat room if you can throughout the course of the trading day. We'll not only be trading live, we'll be looking for trade opportunities, but we're going to kind of give you blow by blow of much of the volatility we've seen. Last, but definitely not least, the volatility futures themselves have actually flipped. That means the short duration volatility, okay, is now more extreme than longer duration volatility. We'll explain that on Monday in a lot more detail. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.